prepare for the today practical question, okay, as well the tutorial question. All right, so let's have a look at what did we learn in the previous section. Okay, so this chapter is really important, and then I'm surely like 100% sure that it will appear in your exam. Okay, it's not all the chapter that will be appear in your exam, but this is considered to be like the critical chapter will be appear in your exam, especially for the exercise question, right? The source answer question, like the leverage buyout, right? The LBO, and then the deal restructure. Okay, that's something you need to be practiced a lot. Okay, just see the method from Ngọc Diễm. Okay, and then later on we have Minh. Okay, so wait a little bit. Ngọc Diễm and Lê Minh. Okay, so we still have some student absent here. Việt An, Mỹ Hằng, and then Phương Thảo. Okay. All right, so previous section, what did we learn in chapter 10 from Titman? Okay, so let me share the screen a little bit. And then I think that you need to like remind again for this chapter 10. Okay, just wait for me. Okay, here. Right, just wait a second. So as I told you many times is that calculation question is not too difficult. However, Dr. Đức really want to ask you about what is called a reasoning question, right? Reasoning question about, for example, if you got the numbers, okay, and then they will he will ask you something about a number, right? It's not how you calculate the number, but what is the meaning of that number? Okay, so that is something you need to be mindful about for your exam. Okay, so for this chapter 10 from Titman, this is also the last chapter that we learned in this valuation class about how can we conduct valuation in a private equity setting. Okay, so here we learn about the market for private equity. So you must know that how this market for private equity works, right? How many parties that involved in this market for private equity, and then how can they raise the fund? Okay, from this source of from this source of capital in this market. Okay, so obviously, I think that you need to have a look at here, right? So maybe I'm not sure about the exam, but maybe Dr. Đức can ask you how this market works and then how many like parties involved here. Okay, so it means that actually, you know, as I have explained to you about private equity firm. So private equity firm is not a kind of like purely corporation, but it's a kind of financial intermediary. Okay, so this kind of financial intermediary, they will work as a kind of like firm to help the other to raise the capital. Okay, especially for startup company and then venture capital company. So this company, they find it very hard to raise the capital from the shareholder, from the bank. So this private equity firm is a kind of financial intermediary that involve raising the pool of capital to invest in company that need financing. Okay, as I told you, startup or maybe some kinds of like private company that require this source of finance, but it feels it like hard to look for the source of capital in the market. Okay, so here we have basically some parties that involve in this private equity market. Okay, so I think that you need to remember what is called the market for private equity and then how this works, okay, between parties. So we have supplier of fund like private equity investment company and then the business that use the fund. Okay, so BE investment company is what we call the private equity firm. Okay, intermediary right here. They raise the capital from the investor, right, from the supplier of fund. Okay, and then they take some owner here. So they will provide that back this capital to the needed business. Okay, it means that new venture, like some kinds of like startup company or maybe the public company as well. Okay, so talk about private equity. So there are many things here that you may discuss. Okay, the first is that okay, someone just switch on the cameras, right? Sorry, switch on the microphone. Okay, so the first thing here, that we discussed about private equity, right? Two specific private equity valuation example is like, firstly, the deal structuring problem. Okay, the deal structuring problem is when that is arising when a venture capital a firm, right, make an investment in a startup firm. So because when they make investment, so they will have to like return back what is called the number of shares that is raised from like the startup company, right? And then they need to forecast what is called the hope for cash flow to value up the to value the startup firm in the market. Okay, so that valuation is, I always tell you about discounted cash flow from the future back to the present using the discount rate to reflect the risk of the company. Okay, so how can an investor value a startup firm? Because that startup firm we may lack of some needed information about the risk, and then that the risk for startup firm like is fluctuated over time, right? Fluctuated due to the business cycle of the firm, and the discount rate may be different for different periods of time, and then because of that it will affect to the hope for cash flow in the eye of the like investor. Okay, so that is the deal restructuring, the first problem that we discussed here in this chapter. And then the second, but also very like critically important, that is the LBO. Okay, so you will need to get familiar with the LBO, what is called like the like a leverage buyout. Okay, leverage buyout. So it means in this case, this kind of LBO represent what is called a business acquisition strategy, whereby you have an investor group acquire all equities of a firm and assume the amount of debt that it borrowed to buy that firm. Okay, in all cases, it will always assume that the amount of money that is borrowed to purchase that firm is up to 50 or 80% of the purchasing price. Okay, that is the amount of money that raised from the debt borrowed of the other investor. Okay, so how can this like raising amount of debt affect to your valuation of this company? And then how can it affect to your purchasing like decision when you want to acquire this company? Okay, so that's something you need to be mindful about this chapter, right? Deal restructuring and then the LBO, right? Leverage buyout. So let's move to the questions. Okay, so we will discuss more about those kinds of problem in the practical question, and then it will help you a lot, okay, in your exam. So let me share a little bit for today's question. We have up to 1, 2, 3 questions. Okay, 3 questions with 2 small questions and then 1 big problem is 10.9. All right, so let's see that if anyone that I have to call you to present today. Okay, so let's have a look here. So I would like to ask for 1 student, firstly, because we need to discuss problem 10.1, right? 10.1, which is only 1 very simple question about the return on equity given different rate of returns on assets and then different like debt borrow to finance for the assets. Okay, so problem 10.1, 1 student please. Anyone here volunteer? All right, so especially the student that haven't raised their hand. Okay, of course, right. Okay, so Duyên, you can share the screen and then present the question.
Can you wait a minute? Because I use my phone, so I need a friend to share the screen for me.
Okay, of course. All right. Maybe. All right, can you guys share the screen? I'm not sure, like, because I'm the host, so that I can share the screen. Okay, so I think that Duyên can share the screen already. Okay, good.
So this is the questions, 10.1, and we need to analyze the effect of financial leverage on the rate of return on KB equity. First is the 15 return of assets. You can see we need to calculate the cost of equity, and this is the formula. So the cost of equity equal to cost of assets deduct the cost of debt plus weight of debt and divide by weight of equity here. So we got the answer is 17.57%. And next is 21%. With the 4% return on assets, with the same formula, we got two answer is 1.86% and minus 1%.
Okay, right, stop here a little bit. Okay, can you come back to the formula on how you estimate the cost of equity? How can you estimate the cost of equity? You take the returns on assets minus the, let's say the cost of equity, and then multiply with C5, cost of debt. Why you multiply with cost of debt and then cost of equity and then divide it by weight of equity. Okay, it's not quite clear right here, so I'm not sure that we have the formula like this to estimate the cost of equity, even though you got the correct answer for cost of equity. But I think you need to make it clearer for the formula that you use here, because I'm not sure. Cost of assets minus cost of debt multiplied with weight of debt and then divided by weight of equity. Okay, so it makes sense here. I think that you just pause the formula right here. So where did you got the formula? Where did you get the formula? Can you share with me this formula? Anyone? Yuen, can you continue? Cost of equity. The question asks you to estimate the rate of return on equity, right? Or it could be the cost of equity. So like, how can you come up with this like formula? Can you share with me? I'm not sure I know this formula, or maybe you just like shorten the process of calculating the cost of equity and then come up with this formula.
So I got it from the WACC.
WACC. Okay, WACC. Okay, so here, WACC. Okay, I see the point. Okay, so I see that WACC, right? Okay, so here I think that you talk about the cost of assets as WACC, right? The cost of raising capital for the company, and it includes two important sources of capital like equity and then debt. Okay, so if you use WACC, you need to make it clearer right here, because I'm not sure that everyone here understand this formula. Okay, and then where did you got this formula, right? You should explain it. Okay, so if you use WACC, you should explain it clearly. Okay, so given this formula, you can come up with the cost of equity or maybe the return on equity. Okay, to be okay, can you go back to another? Okay, I need to see the number. Okay, 17.57%. Okay, and then I think that you guys have the correct answer. Okay. Okay, so here, you know, for the calculation, it's not too difficult, right? However, if Dr. Duc give you this section, this question, a very simple question. However, Dr. Duc may ask you about the relationship of cost of equity or returns on equity with the level of debt that the firm borrowed to finance for the company. Okay, you can see here, given different level of debt, it will give you different, what is called the cost of equity, and then given different rate of return on assets. Okay, so you can see here, the more we borrow the debt to finance the company, so it will make the cost of equity to be lower. Okay, see that 4% return on assets, and then you see that 30% debt on assets, so it's make the cost of equity to be lower. And similarly, right, still 4% on assets and then 30% on debt, so it means that here, sorry, 50% on debt, so it should be like it's a minus 1% for cost of equity. Okay, but why is that? So you need to illustrate this relationship, right? For example, how can we estimate the cost of equity, right? If we don't base on WACC, so you know that cost of equity or maybe returns on equity, right, is estimated based on what is called like the weight of equity and then the net income of your investment, right, of your company. All right, so let me share with you the explanation for this question. Okay, so thank you, Ying, for your answer, pretty clear. Okay, so here. Okay, again, you know, calculation is not difficult, but again, this is about you, how you understand and then interpret the answer. Okay, here. So I'll have the similar numbers with a Ying and then with Ying group previously. However, the way that I calculate the returns on equity is different. Okay, because the question asks you the return on equity, so I don't want to confuse you using the cost of equity formula or WACC. So I use this formula. Okay, returns on invested capital here. It means you take NOPAT, right? NOPAT is net operating profit after tax divided by invested capital. Okay, so here we have assessed of this company to be $1.5 million, and here put it here $1.5 million. And next we have the cost. Okay, this company has the opportunity to like recapitalization and then involve borrowing 30 to 50% of the firm assets at a rate of 9% per year. And we have the annual return to be 4% to 15%. Okay, this is the returns on capital employed. Okay, returns on capital employed or maybe returns on assets. Okay, because when you have that source of capital, so what is the return that you expect from that borrowing of capital? Okay, because here you need to borrow the money to for the process of recapitalization. So when you borrow the money, that equals 30 or 50% of the firm's current assets. So what is the return that you want from that invested capital? Okay, so obviously you see that we have some different scenario for the rate of assets and then the rate the amount of debt that we borrowed for the recapitalization. All right, so let's follow step by step for this calculation. Okay, so the first scenario that I estimate right here is when you the first alternative is when you borrow 30% of debt. Okay, 30% of debt out of assets for the recapitalization process. Okay, sorry, give me a second. Okay, so how can we come up with the returns on equity? Obviously, you need to have what is called like the net operating income, right? And then the amount of equity that you borrow, okay? Sorry, that you raise from like the shareholder for this recapitalization process, okay? Because you borrow 30% from like the amount of debt, so it means that the remaining of 70% is when you raise the capital from the shareholder, right? Is when you have the equity capital. Okay, so how can you estimate the net operating income? Obviously, here, you know that the return on like net operating income, right? So we can follow this formula. Is that here? This is the invested capital, and this is the returns on invested capital, and then it's equal to 15%. Okay, so to estimate the net operating income, net operating profit after tax, you just need to take the return and then multiply with the invested capital. So $1,500,000 multiply with 15%. So you will have this number. This is a net operating income, like after tax, right? Net operating profit or income is also fine after tax. Okay, here we have like interest expense. Okay, because at the end of the day, if you want to estimate returns on equity, you need to have the like net income. Okay, net income. So how can we estimate net income? Obviously, net operating income is when you just like estimate the amount of net operating income, and then after you like pay tax to the government. However, you need to consider the interest expense, right? Because it haven't been deducted in the net operating income, so that's why we have to let it right here. Okay, so how can we estimate the interest expense? Obviously, you see that the borrowing rate is 9%, and then 9%. Okay, 9%, and then the amount of money that you borrow is 30% of this 1.5 million. So 9% of 30% of 1.5 million, this represents the interest expense for you. Okay, you see that I multiply together of the number here, right here, and then 9%, okay, to come up with the interest expense. And because of that, when you estimate the interest expense, you can come up with the net income easily, right? Is when you know we need to less the amount of interest expense to come up with a net income, okay? And if you have the net income, so here you can find out the returns on equity easily is equal to the net income and then divided by the invested capital, which come from the source of equity. Okay, here we have 30% of debt. It means that 70% of the source of capital come from like equity investment. So it means you need to take 1 minus 30% is equal to 70% and then multiply with the invested capital. Okay, so that is the source of money that you raise from the shareholder of the company. Okay, so obviously you can come up with 17.57%. Okay, so you will do it similar for the case of like 4% returns on assets or maybe returns on invested capital, and you can come up with the returns on equity to be right here. Okay, so in this question you can see that we have different returns on equity for different alternatives, right? Is when you borrow more or when you borrow less. So what happened to your returns on equity? Okay, so I think that you need to have a look at this relationship because you know that when the level of debt increases, right? When the level of debt increases, so the amount of equity will decrease, right? Because now we raise the capital mostly from the debt borrowing from the other investor. It's not from equity. So equity will decrease. And then equity is a component in the return on equity component, right? In the returns on equity indicator, right? We take net income divided by equity. So if we have a lower equity, it will make the ROE to be higher. Okay, that's why you can see that ROE in this case is higher given a higher amount of debt for the second alternative. Okay, and secondly, right, at the same time, if a company, right, they borrow more and more debt, so it will make the total assets, right? The total assets is mean that the amount of like invested capital to be higher, right? Given the higher amount of debt, and then you know that given the higher amount of debt, so it will increase the ROE in relation to the returns on assets of the company. Okay, so obviously here, how can we estimate returns on equity, and then what factors that is affect the return on equity? So if you can understand that those components, so you can see that we have a very close relationship between returns on equity and then the amount of debt borrowed to finance for the company and then to finance for any kind of investment for the company. Okay, so here are some of like the very simple question, but maybe Dr. Đức will try to like ask about your understanding of returns on equity and then the relationship with the debt the company borrowed to finance for the company. Okay, so that is what we have for question 10.1, and then let's continue with another question. That is 10.3. Okay, 10.3. So 10.3, what is it? 10.3, a calculation question again for deal structuring with A and B. All right, so I think that this question is pretty simple. So I just need one student to present for 10.3. And then I see here some student raising the hand. I think that Đạt, right? Is raising your hand? Is it you raising your hand? Okay, your name is Thành Đạt, Lê Bá Thành Đạt or Nguyễn Thành Đạt?
Lê Bá.
Okay, Lê Bá Thành Đạt. All right, of course. So you can share the screen and then present 10.3.
Yes, teacher, but I can turn off my camera to make sure that my connection is good.
Okay, you can turn off the camera.
Okay, so this is our group. This is our group about 10.3 problem. So the first one we like we put here all the information we got from the problem. So the EBITDA from zero, we call it 8. Just don't like don't make attention on ABC, D, F, G, because it is the letter that we put it. Nothing. So the first one, we will calculate the EBITDA in 5 years. The formula for it is the D equal to the A multiplied by 1 plus the growth rate, extension by the years, and we got the answer here. And the value for firm in 5 year F equal to the EBITDA multiple multiplied by the EBITDA in 5 years. We got the answer is nearly 14 million. So the required rate of return, and we will calculate the present value for the firm. So H is equal to the value of firm in 5 years divided by 1 plus the required rate of return, which is extension by the years. So we got the answer here. And for the question B, the fraction of the start code is equal to the initial investment divided by the present value of the firm. So we got the answer is equal to 38.63%. So that is my our presentation.
Yes. Okay, very good. Thank you, Deck. So, all right. So I think that you guys have a very good explanation here, and then the calculation is pretty clear. Okay, so this question is not, difficult, right? Deal structuring is not difficult. However, here maybe Dr. Duc will ask you something like the reasoning question. Okay, and here for the calculation, if you estimate like the present value, the enterprise value, and then you come up with the amount of shares that is needed. As you know, for an investor, if they want to invest in this like venture company, in this startup company, so how many shares that they need to have, right? They need to hold in order to like what's their initial investment. Okay, right? So I think that we have a very good calculation here. Okay, thank you, Dak. So let me share again a little bit for this question before we move to like the problem. Okay, the more complicated problem, that is 10.9. Okay, so let me share the screen. Okay, right. Thank you. Good, it's good. Okay, so here, okay, let's wait for me. I think it. Okay, so 10.3 is not too difficult. Okay, and then it's about deal structuring. Okay, deal structuring. Okay, it means that a deal between the venture partners and then an early stage company, right? Startco in this case. Okay, so you know that early stage company require a huge amount of like return for investor to compensate for the risk that they will have to face. Okay, so especially for startup company, as I just mentioned for you, right? They will fluctuate due to the business cycle, right? Early stage, so higher risk, so it means that investor, when they want to like invest in this company, they need to have a high return to offset for the risk that they faced. Okay, so here we have venture partner, and then it's looking for a possible investment in this early stage company, and then they have some kinds of possible information because this investor require 40%. Okay, so here you know that in reality, later on, if you want to invest like capital in some company, you can follow the deal structuring, right? Structuring to come up with the amount of shares that you need to have. Okay, it's just like when you watch Shark Tank, right? You know that they can estimate the amount of shares easily. Okay, just follow the deal structuring. Okay, so obviously the company like expect to grow at the rate of 30%, and then the company earn EBITDA to be like approximately like 700,000 and then $750,000. Okay, and then this company currently being valued at 5 times EBITDA. Okay, so this number will help you to find out the enterprise value of the company at this moment. Okay, based on the EBITDA multiple that we discussed in chapter 2. Okay, in topic 2. Okay, and here no debt, and then there's not plan to borrow over the next 5 years. So can you estimate the enterprise value of the company? Okay, so very simple. We have EBITDA, right? We have EBITDA multiple to be 5. So enterprise value at the end of 5 years, it's just simply the multiple multiply with EBITDA of the company, right? Because you can see that the company currently being valued at 5 times EBITDA. Okay, so enterprise value very simple. You just need to take a multiple and then multiply with EBITDA of the company after 5 years. Okay, so how can we estimate EBITDA after 5 years? Okay, so you can see that we have the growth rate in EBITDA to be 30%. Okay, 30%, and then you know that the multiple is 5. Okay, so it means that this amount of EBITDA will grow at a rate of 30% after 5 years. Okay, so it should be 5. Okay, so you can come up with EBITDA after year 5 and then just multiply with the multiple here, and then we can have the enterprise value. Okay, so enterprise value, remember for me, we have the formula already to estimate the enterprise value. And in this case, because the company has no debt, so you don't have to minus the amount of debt when you estimate the enterprise value. Okay, however, if we have the debt here for the company Starco, so you need to minus the amount of debt. Okay, so you just need to have a look at the enterprise value that we discussed in topic 3 and then topic 2. Okay, and here, right, option B, very simple, right? It just asks you like how much, right? For like what fraction of stakeholder this venture partner need to owe at the end of 5 years, right? So very simple, we have venture capital required. Okay, because you can see here venture capital investment at first, and then is equal to $1 million. Okay, $1 million. So the required rate of return is 40%. So it means that the required, right, venture capitals at the end of 5 years is this number. Okay, and then the enterprise value of the firm is this number. So it means that the amount of ownership that this venture partner need to hold, it's just simply the venture capital required and divided by the enterprise value of the firm at the end of year 5. Okay, so here I see that you can refer to this calculation like step by step to come up with the venture percentage of venture capital ownership, and as well as the amount of shares that is needed for this venture capital, right? When you invest in this company, right? You can see here, right? In case when the question asks you how much, right? How many shares, how many ownership shares that this like venture partner need to have. So just follow the formula here. Okay, right. So that's something for problem 10.3. And then let's move to a more complicated problem that is 10.9. Okay, 10.9, we have A, B, and C. Okay, so let's continue with 10.9. I have emailed you for permission to leave the class earlier. Okay, you can leave now. G, right? Okay, for your flight. So let's move to 10.9. All right, 10.9. Any volunteer for 10.9? Any volunteer for 10.9 and then would like to share with me? Okay, 10.9. Right, 10.9 is very like complicated calculation problem, and then it requires you to be like understand the LBO like clearly in order to come up with the answer for A, B, and C. Okay, so question A first, student. Anyone here will volunteer? Especially those students that haven't raised the hand. So if you don't raise the hand, so it means that you will receive nothing for your like participant score, right? Participant score, and that will be 0. Okay, any volunteer? Just say something. I just hear someone say something. It's not. Mm. So I think that maybe I just currently a person, and then I need to listen from you first before I jump to my discussion. Okay. Okay, we have 1, 2, 3, 4, 5. Someone that I haven't called your name. Okay, just wait for me. So I will call Thủy, right? I haven't called you. So Thủy, please, can you share the screen about your group result? I see that you are in the list of the students that attend today's section. So can you share the screen, Thủy? Or just like this group? Okay, you can share the screen and then present to me first.
Maybe our groups hasn't done yet.
Haven't done? Okay, which group is that? Okay, you need to like at least like try to practice that question first before I share with you, because if you don't practice, so and then when I share with you the explanation, so there's no way that you can understand. Okay, so I will put a note here, and then I will ask another student, maybe Chánh Thống, right? Can you share with me your group result? Maybe I haven't called you. Yes, Chánh Thống, please. All right, where are you? I see that you are on the list here, so can you share the screen? I think that you may sit next to a person. I'm not sure. Okay, anyone? Chánh Thống, are you here, or do you want me to mark you as absent? Like, I don't see you on the screen as well, even though I see your name on the list. Okay, you need to have some word, or maybe I will have to have a look here at which group are you in, so that I will call similar members in the group. Okay, you don't have to be worried about your answer, right? At least you try, so I'm like totally fine. Okay, right or wrong, I don't care, but at least you try to share with me like your group result. Okay, so that is my like recommendation for you. So don't be afraid of like presenting the question in the class. Okay, just share with me your work. Okay, so here we have some students. Okay. All right, I think that Chánh Thống may belong to group 2. Group 2. So anyone here from group 2 can share with me your explanation about 10.9? Or maybe just let me know the truth, like have you prepared, or maybe it's difficult for you or whatever, so just let me know. Okay, anyone?
I'm Thảo Nhi from group 2. I'm sorry, but we do the wrong problem. We do 10.10 instead. So can we present it? I'm sorry.
Okay.
10.10.
Okay, don't worry. Okay, so 10/10, right? All right, so at least you have the reason for that, so it's fine with me, but you need to tell me that. Okay, so I think many of you, I think that is not a simple question for 10.9, so I think that I will share with you the calculation because we don't have much time. Okay, so listen to me well. I'm not sure like whether it will be in your exam or not, but please listen to me about 10.9. Okay, this is a very long question, and then the calculation is a lot. Okay, so how can how can we come up with the correct answer? Okay, how can we answer question A, B, and then C? Okay, it's just a calculation question only. Okay, however, you know that Dr. Đức love to ask you about reasoning question. So this just like a small part in your exam. Okay, however, that will give you a general picture on how we conduct the LBO evaluation. Okay, so here, right, we have some of like the case, like it's just like a case study. And then we have Randy Dillingwater is like a chief investment officer for Clearstone Capital. And then this is a privately equity firm located in Orlando. So later on, you see that Clearstone is now completing the investment of its second fund and consider the acquisition of a local manufacturing and distribution company. Okay, so Clearstone want to have this transaction of acquisition for a local manufacturing company. Okay, so how can it do the valuation to purchase this company, right, Flander? All right, so we have some possible information right here. Is, you know, that the owner of Flander company, right, just prepare the pro forma income statement, right? Pro forma income statement is like the income statement forecasted for the upcoming period, okay, from year 2016 to the year of 2020. Okay, this is the pro forma income. And then based on the pro forma income, we have some possible like information right here is that, you know, like the invested capital would be 4 million a year. And then new capital would have a 10-year depreciated life. Depreciation expense in year 2015, 15, right? What, 3.5, okay, this is the initial depreciation expense. And then this addition of 4 million in capital expenditure will add 400 in added depreciation expense. Okay, so this sentence is really important for you to come up with the depreciation expense for year 2016 to year 2020. Okay, that is the first information that you need to highlight here for the question. And secondly, you can see that the owner of Flander, right, suggests a 5x EBITDA multiple to value the company. Okay, so it means that at the end of year 2020, you have EBITDA of the company and then you multiply with 5. So this is the enterprise value of this company, right, of this Flander company without debt borrowing from the other investor. Okay, and later on you see that we have some basic assumption here. When this investor, right, when this Randy Dillingwater like conduct the valuation for this Flander company, right, they make some assumption right here. And you can see that the company can be purchased for 5 times the firm EBITDA in 2015 of 10 million and resolve in 5 years for the same multiple. Okay, so it means that the multiple today and then the multiple after 5 years is still the 5 times of EBITDA. Okay, the second assumption is that finance 90% of purchasing price using debt. Okay, so that is a very important characteristic of the LBO. When you know the amount of money to finance for the LBO transaction is up to 50 to like 90%. That is borrowed from the debt. Okay, borrow from the debtor. Right, sorry, from the amount of debt. Okay, and later on we have some basic assumption that is, you know, 14% rate of interest. Okay, the amount of interest that you need to pay, and then like 30% of tax rate. Okay, and then capital expenditure to be 4 million per year, no net investment. Okay, so what happened? Okay, just give me a second. Okay, so the question asked you about like what is the projected, okay, the forecasted enterprise value of Flander in 5 years. Okay, so to come up with the enterprise value, you need to have them like EBITDA after year 5 and then the multiple to be 5. Okay, here you have the multiple already 5 times EBITDA. So you just need to come up with the EBITDA in order to estimate the enterprise value. And then here, what is the estimated of Clearwater equity in the firm at the end of year 5. Okay, of 5 year if everything works out as planned. Okay, so right, that is for question A. And then B, what is the rate of return should please not expect on equity in the acquisition under projected, like projection method. And then, you know, C is that. Okay, so I think you need to understand A and B first, and then later on you can understand C later. Okay, so A and B here. So let's come up with the calculations part. Okay, so very simple. For the first question in like the option A is that enterprise value in 5 years. So you know that EBITDA at the end of year 2020, right? After 5 years to be this amount of money. So you just need to take this EBITDA and then multiply with 5. This is like the multiple. So you can come up with the enterprise value of the company to be this amount. Okay, see that? 5 here is the company like EBITDA. Okay, EBITDA at the end of 5 years, 5 like multiple and then multiply with EBITDA of the company after like 5 years. Okay, that is very simple for the first question. However, the second question in this option A is that what is the estimated value of Clearwater equity in the firm at the end of 5 years? Okay, value of equity. Okay, value of equity is mean that the company here, you know, we purchase this company using debt and then equity at the same time. So what is the value of equity at the end of 5 years? That is a question. Okay, so I just give you a very like a hint right here to come up with the equity value. Okay, because you know that when you purchase this company, you borrow a certain amount from like the debt borrowing from the company, like from the firms or maybe from other investor. And then the remaining amount that you will have to like raise the capital from like equity issuance. Okay, so obviously equity value equal to the selling price minus the loan balance at the end of 5 years. Okay, loan balance is mean that the remaining amount of debt that you need to pay for like investor that provide you the money for your investment, right? For your purchasing of this company. Okay. So how can we come up with this number? Okay, so let me share with you the calculation. Okay, so firstly, all right, let's have a look at this information. I think that I may forget to tell you. Okay, here, you see that the debt will require a cash sweep so that all available cash flow will go toward the repayment of the note, right, of the debt note. So it means that if the company earns some money in cash, it will use all of that money to pay back the debt that it borrowed to purchase the company at first. Okay, and you can see that firstly the company they like finance 90% of the purchasing price with the amount of debt. So during the operation process for 5 years, when it collect the EBITDA, so it will use that source of money to pay back the debt that it borrowed at first. Okay, that is very important because that will help you to estimate the loan balance at the end of 5 years. Okay, so firstly, you can see that EBITDA, this information we have from the question already. Okay, right here, EBITDA from 2016 to 2020. Okay, so how can we like estimate the principal payment and then the loan balance at the end of each year? Okay, firstly, you know that for this calculation step, so it just asks you to estimate the cash inflow and then the cash outflow of the company, right? So given EBITDA, what is the cash outflow that the company needs to spend, and then what is the cash inflow? Okay, so obviously you see that it's just all about the cash outflow because the company they need to spend 4 million per year for the investment. See that 4 million per year for capital expenditure. So 4 million is added as capital expenditure per year. Okay, what about depreciation? So even though depreciation is a non-cash item, but you know you need to account for estimating the amount of like loan balance. Okay, depreciation in year 1 is very simple. Okay, because we have the information right here for the assumption. Depreciation expense in year 2015 to be 3.5, and then additional amount of 400 will be added in the next upcoming year. Okay, so very simple. 3.5 and then plot 4 million divided by 10. Okay, 10 is a 10 depreciated life, and you can come up with the depreciation in year 1. Okay, see that 4 million divided by the amount like the assessed life, okay, to be 10, and then plot the previous initiation like depreciation spent. Okay, so actually this is calculated at accumulated depreciation, right, for this year and then the previous year. Okay, so we come up with depreciation expense and then interest expense. Very simple. Okay, interest expense is the amount of money that you pay on the debt you borrowed. So firstly, you can see that the purchasing price of this clear stone company is $50 million. Okay, so how can we have this $50 million? Very simple. Okay, here you can see that this assumption tell you the company can be purchased for 5 times the firm EBITDA. Okay, so the firm EBITDA in year 2015 to be 10, and then the like multiple to be 5. So 5 multiplied with 10 is when you have $50 million. So this is considered to be the purchasing price of the company at first. Okay, and then with that $50 million, you will borrow 90% of 50 million, right, as the amount of debt to purchase this company. Okay, so the interest on that 90% of the purchasing price, that's how you come up with the interest expense. Okay, all right, so here I just do the math functions, but you know, you don't have to put the math function right here. You just need to multiply like 50 million with the 90%. This is the amount of debt that you borrow to purchase the company, and then the interest rate on the debt is 14%, right? It's from the question, so you can come up with the interest expense to be approximately this number. Okay, so the loan balance, this is the amount of money that you need to pay after you take EBITDA and then minus all of the cash outflow. Okay, so this question. All right, but also please pay attention to the tax. Okay, because tax payment is a kind of tax outflow, right? A kind of capital or a kind of cash outflow. So you need to minus the tax. Okay, so I think you can refer to this formula because I think that it would be like easier for you to follow. Okay, so EBITDA here. Okay, firstly, the amount of money that you borrow from like the other investor to purchase the company. So 90% of the purchasing price. Okay, 90% of the purchasing price. This is the amount of debt that you borrow. Okay, minus the cash inflow. Okay, cash inflow in this case it's just only EBITDA because the company like operate and then it's received the EBITDA. That is a cash inflow, right, for you. Okay, however, cash outflow is a lot because you need to pay for capital expenditure, depreciation expense, and then we have the interest payment and also the cash payment. Sorry, the tax payment. Okay, so how can we estimate tax payment? So the tax rate is 30%. Okay, the tax rate is 30%. So how can you estimate the tax payment, right? Tax is, you know, that the tax on the net income, right? Net income. So how can we estimate net income? Very simple right here is that, you know, that EBITDA is like the earning before interest, tax, depreciation, and then amortization. So if you just like take EBITDA and then minus depreciation, minus interest, so that is the net income. Okay, and then the tax on net income is the amount of money that you need to pay for the government. Okay, so here estimate the cash inflow and then cash outflow, so you can come up with the loan balance at the end of year 1. So it means that after year 1, you can pay like you can pay back the money to the debtor, like the amount of money that you borrow to purchase the company is up to like approximately $6 million. Okay, that is the amount of money that you can pay for them after year 1. Okay, after year 1, right? It means that you may borrow, for example, here, right? Let me make it clearer for you. You borrow up to $45 million. Okay, in year 1, you can pay for like I'm not sure. Okay, 460,000 only. Okay, you borrow this money, you pay this money. So this is the amount of money that you need to pay in the upcoming year. Okay, the loan balance. Okay, you get the point right here, right? I'm not sure about the exam, but maybe Dr. Duc will give you this question in the exam. Okay, so you need to be mindful about how can we estimate the loan balance and then the principal payment. Okay, that will help you to come up with the equity value at the end of year 5. Okay, so listen to me well. Okay, so okay, we will do it similar for the upcoming year for estimating the principal payment per year. Okay, just follow the technique that I share with you here for EBITDA. Okay, this is the number that we have from the question. And then capital expense will be similar from year 1 to year 5. However, depreciation expense right here. Okay, remember accumulated depreciation. Okay, previous year plus this year to come up with depreciation expense. Okay, so previous year we have like 3,900,000 at depreciation. So you plot with the like this year depreciation to be 4 million divided by the lifetime of asset to be 10. So that is depreciation this year. Okay, accumulated. So and we can come up with the interest expense, right? Because you know that here the interest is just on the remaining amount of money that you haven't paid. Okay, this is the amount of money that you haven't paid after year 1. Okay, so interest on this amount, not on the previous amount. Okay, so be careful when you come up or when you estimate the interest expense for this question. Okay, so here you can see that 14% of interest rate, but this is on the amount of money that you haven't paid, right? You haven't paid yet at the end of year 5. So this amount of money, and then here you can estimate the loan balance, right? And follow the previous formula I just shared with you. Okay, so here you have for like approximately like 44 like million, and then you have the cash inflow to be EBITDA in year 2, and then cash outflow to be capital expenditure, depreciation expense, and then interest, and then remember we have tax as well. Okay, so this is the loan balance at the end of year 5. Okay, so it means that in year 2, right? Sorry, in year 2 you can pay like approximately like 1.4 million. Okay, to the amount of money that you borrow for purchasing the company. Okay, you will do it similar for year 1, year 2, year 3, year 4, year 5. So you can estimate the loan balance at the end of year 5. Okay, so it means that at the end of year 5 you haven't paid like approximately like $32 million to like at the first amount that you borrow. Okay, and then you still have to pay this amount of money for later year. Okay, so equity value at the end of year 5, you have the selling price. You just estimate it firstly. Okay, here selling price, but it means that selling price at the end of year 5. Okay, and then minus the loan balance to come up with the equity value of the firm. Okay, so I think that the most difficult part is right here, right? You need to be like 100% careful when you estimate the interest expense and then depreciation expense. Okay, loan balance as well. Okay, so in case if this question appear in your exam, okay, I show you the technique already. So I need you to be like, give me the correct answer. Okay, right. So that is something you need to be mindful about for the exam. However, you know, because the exam is a closed book, so I think that maybe for the required rate of return, like the internal rate of return, so you don't have to pay attention a lot. Okay, maybe you will have to pay attention for this if we have an open text, and then you need to use Excel to come up with the answer. Okay, however, you know, here the most important part is like how can you come up with the answer for question 8. Okay, for question B, maybe you need to run like lots of the calculation, and then you know to come up with the like internal rate of return on this investment. So I think that the best way for you is to use Excel. However, you know, in the exam we are not allowed to use textbook. Maybe like this is a closed book exam. So I think that the most difficult part is here, right here, just right here. Okay, so need to be familiar with this. Okay, for the calculation. All right, and then later on, because we don't have much time, so I think that I will share with you the slide here, and then you can have a look at the calculation later. Okay, so the option C is not too difficult because it's just based on the previous estimation of A and B. Okay, however, you can see it right here. Is that the company, they can like decrease the operating expense by 1 million per year. So where the company can decrease the expense by 1 million per year, that will add 1 million to EBITDA of the company. Okay, because you can save like 1 million for the like operating expense. So that will add up 1 million to the EBITDA of the company. Okay, so we have the change in EBITDA. So it will have the change in the EBITDA from year 1 to year 5. And then it will affect to your loan balance. Okay, and the equity value. Okay, so you can see that given a higher EBITDA from years to year, you know that the equity value should be higher, okay, compared to the previous example right here. Okay, given we can save like a larger amount for like to pay back the debt, right? To pay back the debt, given the capital like the cash inflow. Okay, cash outflow is a lot, but capital inflow or capital like cash inflow, it's just only EBITDA. Okay, so that's just somehow, you know, how can we come up with the selling price and then at the end of 5 years, right? And then the equity value at the end of 5 years for this like LBO example. Okay, so I think that like we just run out of time for my section. So later on, right, when you do the revision and then if there's anything that you're unclear, and then maybe for your group assignment, the group projects that you want to ask for my advice or something like that, just send me an email and then ask for a meeting with me. Okay, I will share with you anything that I want you to know about the exam, and then maybe for the group projects if you want. Okay, so just send me an email if you want a meeting with me personally. Okay, like group meeting. Okay, so I will arrange the meeting with you. All right, so I really hope that you guys have a good performance for the exam, right? Because we still have a month for military course, so it means you need to be like take note carefully. Okay, otherwise when it comes to the real examination, I'm not sure that you can pass the course, right? If you just failed the exam, so it account up to 50%. Okay, so it will affect your score a lot. Okay, so good luck with your exam, and then I hope that you will have a good preparation. Okay, so see you all later, maybe in your graduation date, right? I hope that all of you guys will pass the course. Okay, so here, this is the upcoming section with Dr. Kim. So let's have 5-minute break, and then Dr. Kim will join the class to deliver the last section with you guys. Okay, so see you all next time. Okay, goodbye. Okay, so I think that she's here. Okay, make host.
Yes. Hi everyone. As Miss Lin just said, we will have a break. Yeah, and I will be back say at 1:30. Okay. Have a good break.
Anything with the case, teacher? Yeah, sorry, we are busy on the evaluation project and exercise. We haven't do anything with the cases. Yes.
So can I ask, have you guys read the case yet?
Yeah, not yet, teacher.
Not yet either.
Yes.
Okay. Anyone of your group individually read case 10.8? Anyone? I just want to confirm if anyone of your group individually prepare case 10.8 yet.
I personally haven't read the cases. Yeah, and other members, I don't know.
Yes, thanks for answering. How about the other one? How about other member of group 5? Okay, so how about group 4? Any of the group 4? Any member here? Group 4. That's not good. Okay. Then group 3.
So I'm leader of the trees.
Yep.
Sorry for our group did not do the case 10.8 because the last week we don't have do the case study about it, the last tutorial for the Starbucks. So our group think that this section will do something on that and just brief look at the case 10.8 but not do the case 10.8.
Okay. Okay. Can I ask if you ever read the case? Just read it, and do you have any feeling? Do you think that you can do it if you have time?
I have read it. It's the like the basic requirement. Like we can apply the formula of the method teach us. So I think if have time we can do it.
Okay, thank you. So can I ask group 2?
So I'm represent for group 2. So we read the case and we do some question of the case. So I can share screen now.
Thank you. Thanks, Nhi.
Okay, so the can you see my screen now?
Yep.
Okay, so the case is about Dub. So after he built his company and with the debt and equity, so we can see it in the financial structure of Dub. So now he's determined that he need to raise more. He needs to have more money. So he decided that he need to provide preferred stock, but at the same time the bank tell him that the company like him can sell the company for 5 to 7 times their EBITDA. So at that time at that time we can see that Dub now have the financial structure, and the question asked and from the question A, they asked us to estimate the enterprise value of Dub in the 2020 with the hint that we can use the EBITDA multiple of the EBITDA and then plus the firm cash balance. So we do the question A as the hint give us that we can calculate the enterprise value of Dub by using the multiple of EBITDA plus the firm cash balance. So we use the EBITDA here, the multiple of EBITDA, so we can have the EBITDA value, and then we plus cash, so we have the enterprise values like the question give us the hint, so we can easily do that. That is the enterprise value. So if we want to calculate the equity value, we need to less it with the interest-bearing debt. So the question A is really easy to do. So is that right? Just estimate the enterprise value. Right. Okay, so I just keep presenting. So so from the question B, the summarize of the question B is that if the enterprise value we calculate in the question A is correct, so how can we calculate the rate of return when the subordinated debt holder realize if he converts in 20 and 20? So if we want to estimate the interest rate of return for the sub debt in the period of 6 years, we need to use the IRR formulation. So in the IRR formulation, then we need the sub debt interest income and the conversion value of the sub debt. So that is the payment, the amount of payment, and we already have the period, the payment period for 6 years, so we can easily calculate the IRR of the sub debt in 6 years. That's the formula, and I paste the formula here. So come to the question C, we have some problem in calculating it, but we think maybe it's right. So in the question C, the question asks us to first estimate of the ownership distribution of debt in equity in 20 and 20. They assume that the new investor, guess what he requires to earn the 45% required rate of return, and the subordinated debt holder converts to common. So the first part, we need to calculate the ownership distribution of debt. So to calculate that, we need to have the required equity owner percentage. So by calculating that, we need to have the future value of the conversion value to produce the right rate of return. This is the future value calculated by the formula. I also put the formula in the Excel function here. And this is the convertible preferred stock dividend that the payment amount that we pay to the dividend when they buy our preferred stock. So from that, we can have the required equity ownership percentage by divide the required equity conversion, which means the future value. We use that divided by the equity value. But in the second part of the question C, we have some problem because we don't know how to calculate the Tarrant rate of return. And though we have these the numbers from the problem, they give us these two number dash and I'm sorry, the problem give us 10% and 45%, and we can calculate that percent and that percent due to the problem B and C. So we can have the rate of return and equity of ownership like 31 and 38 here. So by subtract it from 100%, we can have the equity ownership percentage, but we are figuring how to calculate the rate of return of debt. That's the end of question C. about question D, what would the expected rate of return if the EBITDA multiple were 5 or 7? So we do not have the clear answer for it, but at that time we know that if the EBITDA multiple were 7, the expected rate of return of that will be higher, but we do not calculate it, but we just estimate it higher. So we do not have the clear answer for question D yet. About question E, the post-investment and the pre-investment value of debt equity in 2015 based on the investment of new investor. So this question is calculated according to the additional financing needed in 2015, like the question asked us. So we use the additional financing needed in 2015. Here, this is the number that the problem gave us at the beginning. So it is here. So they 250,000. So we just let the post money value estimate to the preferred stockholder investment, so we can have the pre-money value estimate in 2015. So I think the question is more about the calculation and formulation. Only question D is not calculation, but we do not have the clear answer for this. I'm so sorry.
Very good. Can I ask, you did this by yourself or you did in group? How many people work together in this one?
Yeah, group 2, we work together, both the exercise of Miss Lin
Sure.
and group project and
Yep.
the case.
Okay, so we, I would like to do step by step because I believe that the other group 4 and 5, if you guys haven't done so, so please pay more attention so that it will save more time, save your time. You don't have to study of this case again. Okay, let's start from question A. I will ask, say, group 1 to clarify or say question or feedback, and other group please get the idea of this case and learn from this. Okay, at least you know how and why you do it. Okay, so assume that if you have time, of course you can think and you can do. But now we need to practice and we need to get the habit so that in the exam, if you have this question, you can do it in the allocated time. Okay. So let's go back to the information given and question A. And let's go back to your solution for the question A. And anyone have any question, please please raise your question now. Yeah, please ask if it is correct. I won't give my feedback until all of you say, yeah. If you agree, then I will give my feedback. Okay. Group 1, group 1, group 3, 4, 5 as well. If you have any question, or if you say you can clarify anything. Okay, so while you guys thinking of what you want to ask, then I'll summarize this case. This is about the startup business. You know, when when you are in startup, you have multiple stages that you can ask for capital, right? For fund, and this is the stage of seeding or startup. In this case, you can only ask mostly your friends and for the bank, but it is very hard to get the most out of them. Yeah, and the way to value the business is only to use the EBITDA, because in this case you have no technically even no retained earning, no income, right? Because all of the money you spend more than you earn, so you can only base on the EBITDA, and you will evaluate or you determine the value as multiple of EBITDA. And because the scenario say that the multiple is between 5 and 7, right? So you can say the medium of that is 6, right? So in this case, if you use 6, then you will say the enterprise value is 6 times EBITDA. And what is the enterprise value? Can anyone explain what the enterprise value is? Is enterprise value equity? So what is enterprise value? Is enterprise value the firm value? Yeah, yes or no? Enterprise value is the firm value, yeah? And when we say about the firm value or the business value, it means that we ignore the capital structure, right? So the firm value or the enterprise value, it is the total asset that the firm use to do business, yeah? And it includes the debt and equity, okay? So the firm value or the enterprise value is equity value plus debt. Because say, for example, if you need $1 million to do business, right? That business require 1 million, but you don't have that amount. So you have to ask for debt, right? So in that case, the firm value is the debt plus the equity, your own money. All right. So remember, enterprise value is the EBITDA multiple with the 6, yeah, and then plus cash. So you have the enterprise value, yeah, and then enterprise value. Then you minus the debt. You minus debt, right? So in this case, the debt is whatever. We call the interest-bearing debt. Yeah, the interest-bearing debt is what you owe the bank, yeah, and you owe your friend that you have to pay interest, but not including any accounts payable also. Okay. So the equity at this time will be 4.2 million and minus 650,000. So you have the equity value 3,550,000. Yeah, and that one we the notes here is is incorrect. Yeah, the note here should be enterprise value. Sorry, is the equity value only, not the enterprise value. Even though the amount equity is right, but please remove the enterprise value here. Okay. Yeah. So the enterprise value is the EBITDA plus cash, and that is equal to the debt plus equity value. Yep, and that technically that is called the total firm value, because we have to assume that if you can't get debt and you have to finance everything from equity. So in that case, the total firm value will be 100% equity. Okay. So that is question A. And for question B, I've been doing question A for you guys. It reminded me of one of the question in case 10.9 that Ms. Lin just worked with you. It is also one of the scenario that if the firm didn't borrow, yeah, so it is 100% of the equity. It is similar to the case, one of the scenario in 10.9, yeah. So if you understand one case thoroughly, you can do the other case easily, because when you understand, you can do anything, right? So you don't have to worry what is 10.8, what is 10.9. You just see the scenario and the question, then you can solve it. Just do it, bang, 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 right? So for question B, what we are asked, question B, thank you. It is about the if the estimated price of the enterprise value is SK8 and the interest rate, yeah, the subordinated debt holder realize if he converts in 2020, would you expect the subordinated debt holder to convert to common stock? Okay, so it in this case we just have to calculate if he convert into the common stock, yeah, and how much should you calculate now? Of course, you need to calculate the estimated interest rate. Sorry, the return, the rate of return, or IRR. And yes, your friend, your group 2 is doing very good job. In this case, that you have the subordinated debt interest income is 12,000 per year, right? So every year they will earn this much. It is just like, you know, imagine it is a bond, right? It is like a bond. So you they give you loan of say how much, 200 or 100, right? Yes, 100, and then every year they earn this much, 12,000, and at the end of the how many years from the year 2015 to the year 2020, right? So you have to calculate, like imagine or assume that they loaned you at the beginning of the 2015, right? And at the end of 2020, we have to convert their debt into equity. into 10% of the equity, right? So in that case, your friend use the formula. I think that it is correct. 10% of the equity value of 3,550,000. So that is equivalent to 355,000, right? So at the end of 2020, you will earn, you will convert if you have the right and you agree to convert, right? You already have right. Now you choose to convert that into 10%. And then now your job is to calculate IRR. So you apply the financial function. Of course, now we are calculating their rate of return, or we call the IRR. So use the formula in Excel. Yeah, the easiest way is to determine that I need to calculate the IRR. Then you just go to the financial, the insert the function, and then you choose the IRR, and then it will show you step by step that you have to choose the item accordingly. Yes, so that N will be the number of the period. The number of period here is end of each year. You will receive the income. Yeah, so that is 6. Yes, exactly. Yeah, so I am showing that you don't have to remember the accurate formula. But you just have to go to the Excel, and you can find it is the N for the number of period. It is the periodic income or the inflow. Yeah, and then the beginning value. Of course, the beginning value is the amount you pay out. Yeah, so that should be the minus. Yeah, you pay out 100, right? And at the end, you will receive 355 as a future value. Okay, so you need to accurately put the positive or negative in this amount. Then you will get the IRR exactly as the amount that your friend just find out. That is 31.34%. Okay. So far, anyone have any question? You all get the idea of how to calculate? I need you to understand the question, the context, the scenario. Yeah, you need to understand the way, the direction to solve the problem. Okay, and you need to put the number in the correct position, location, so that you can calculate it correctly. Okay, I believe that if the final exam is in this case, it will be easier for you rather than doing the the financial statement forecast like like Coca-Cola or Starbucks is too complicated and too long. This one is easier. The only thing that worry me is that you need a financial calculator. Yeah, so you don't have Excel in this case. So you need to practice this in the calculator. Because if you have the right calculator, the capable calculator, then you can do the IRR from your calculator easily. Okay, that is the only thing that worries me, if you can do it or not. So that is question B. How about question C? Question C, if the new investor were to require 45% rate of return. Okay, now they say that for my investment, I need 45%. So 45% here, we have to understand that it is IRR, okay? Because in the end, they say that the total or the consolidated investment return should be 45%, right? So you have to put 45 as IRR, yeah? And his initial investment is 250,000. Is it right? Yeah, and 255,000 from beginning will be converted into the equity at the end of say 2020. Okay, and again, if you assume that now mean in the year 2015, okay, I suggest that if in the exam room, yeah, and you're not so sure that it is beginning of 2015 or it is end of 2015, if you're not so sure, you just write clearly what you assume, okay? If you write clearly what you assume, so at least when you write out, it is like you speak out your thought, right? And if you feel that it is not reasonable, then you can change your assumption. In case that you still think that my assumption is correct, yeah, maybe you assume that it is end of 2015, but the examiner, the questioner assume that it is beginning. For example, they still can give you some mark because of, say, the question is not so clear, and they thought that it is beginning of 2015, and you assume it is end of 2015, okay? So in the real scenario, you will be very clear, like when you will need that capital, right? But in the exam room, sometimes you can't think further. You don't have time to think about that so much. So just write clearly what you assume, beginning or end or whatever. When you write clearly, then you need to stick to your assumption to calculate that accurately. Because at the end, if your assumption match with your calculation, then you will have to at least up to the marker. They say that your assumption is, you know, making sense and your calculation match, then you should have the full mark. All right. That is just my experience when you do something that you are not quite sure. So for question C, okay, thank you. For question C, we will have 250,000 for the additional, right? For the additional debt, and this one you will pay how much? 8%, right? So 8% times 250 means you will earn 20,000, and that is the dividend, the preferred dividend, right? Over say 6 years. If I assume that it is the beginning of 2015 and end of 2020, they will convert into the equity. Okay, and we require 45%. So again, you have to calculate the value at the end of 2020, equivalent to how much, right? So this is the opposite calculation compared to question B. Question B, you need to calculate what is question B, the IRR. But in question C, you need to calculate the F value, the future value, right? So the future value, you will, again, you just type the F value in Excel, and then it will give you the step-by-step guidance. Yeah, so here your friend already gives you some notes here. The F value will be first the amount. Sorry, it will give you N as the, thank you. Here it is the rate. So the rate will be 45%. Yeah, 45% as IRR, or effective rate of return. And then the number of period, which is 6. It means 6 times you will receive the 20,000 as preferred dividend, right? And then you have the present value or beginning amount that you pay, right? Which is 250, and it should be negative because that means the cash outflow. Yeah, and the cash inflow is at the end of 2020, which is we are calculating, right? So by that you will, if you enter the function, then that will be that amount, the 1,362,000 and something 89 cents. Okay. Okay. So do you have any questions so far? Even now, if you are on your laptop, you can double check that, right? So you can practice doing the equal FD, and then in the bracket, you can do the same thing, right? You can double check if your friend is doing correctly or not, okay? And in this case, if you convert the preferred stock into into equity, in that case you will earn how much? Now you will take the percentage of the amount, say 1,362,089 cents divided by the total equity. Okay, the original equity of 3,500 something from question A. Okay, and you will get the 38.37%. Okay, so that is the percentage of the ownership of the 250,000. Do you have any question regarding this? That is question C. Any question? That is for question C. If you calculate like that, you will have the 48.37%. Now we will move down to say the capital structure or the final deal structure. Of course, in this case, I will only help you in terms of calculating. And regarding to say the question, should we do it or should the debt holder convert it into the equity? We will do it in the end. Yeah. And also it would be better to say to have a little further discussion about that. Okay. The final deal structure, in this case, if you accept the debt holder converted into the equity. Yeah, so here we have from beginning the subordinated debt holder is 10%, right? And convertible preferred stock is 38.37%, and Daptaran, who is the founder, will be the balance, right? So yeah, it has to make up 100%. Yeah, so 10% plus 38.37, yeah, and then deducted from 100%. Then you have the owner's equity, 51.63%. Okay, and the rate of return, of course, we already calculated the rate of return for the first subordinated debt holder, right? I believe you can do the same. You apply the formula for the first subordinated debt holder to calculate the IRR. Yeah? Yes. Exactly. The only thing is that the owner doesn't receive any income. Yeah, over 6 years, they don't have any income. The only thing is that they have to pay, they have to contribute their beginning capital. Yeah, which is how much? How much? From the beginning, they will, Daptaran will be paying negative 200. Yep. And at the end will be how much? At the end will be 3,500,000 something minus the, or even that amount multiplied by 51.63%. Yeah, you can do anyway. Then you will find out the interest, the rate of return for this. You got it?
Yes, I'm calculating it.
Yep. Yep. Yes.
Yeah, that number seems like correct.
44, 66. Yeah, I think so. I see you put the right number in the formula, so it should be correct. Okay. So that is the question. So you see, even the case like this, even it is simple, it's more simple than the long case for Starbucks also. All right. So for Daptaran, he has say only interest rate, sorry, only rate of return, a little bit lower than the preferred stock, right? The preferred stock have say 45%, and he has only 44.66%. Okay, so that is question C. Question D. What could be the current expected rate of return? All right, you already did that. 44.66. Question E. What was the post-investment and pre-investment based on the investment of okay. The post money value will be you did very well. That is correct. You will base on the percentage, yeah, of the final end of 2020. Okay. So you will have 651,000 as the post money, and then you minus the pre-money. Sorry, minus the amount that you pay from beginning. So the pre-money value will be that much. Okay. So that is the pre-money value of the company. Any question? Do you have any question regarding to post-money value? The post-money value here is the post-money value of the company, yeah, of the equity, yeah. And then when they, that is the, after they deduct the amount that they receive from the preferred stock, then they have the pre-money value. Any question, everyone? So you will see that the current, his interest will be very much depending on what? On the performance, okay? Because for the preferred stock, they need a fixed interest, fixed rate, that is 45%. So it doesn't matter how much you earn, how much you perform. Say if you have, say, 7 multiple EBITDA, then if you want to check, you will check the 7 multiple EBITDA, yeah, and you will see that the parent will earn a little bit more than 45%, yeah, more than 45%. I think 50 something. I guess, I don't know. I'm not, I don't have the accurate figure for the moment, but I believe if you want to double check, because the performance will be between 5 and 7 multiple EBITDA. So if it is 5 EBITDA, then obviously the parent will earn less than 44, even less, because the total equity is only 5 times the EBITDA, right? And they still have to give 45% of the rate of return to the preferred stock. And they will have less remainder for the parent equity. For the 10%, it's still 10%. Only for converted preferred stock will be affected. Will affect the parent equity. Okay, so that that may be the answer that you need to put in the case if the performance is between 5 and 7 multiple EBITDA. Anyone have any question? Any feedback? This question is easy, right? This case is very short and easy. Okay, if you don't have any questions, so we can ask and we can share your updates regarding your project. You can ask anything regarding to your project, regarding to cases, anything. Everyone? So how is your project progress so far?
Our group are going to finish our calculation today, and we will start with some writing our assumption, adjustment, and limitations. I can share our work up till now.
Mm-hmm.
Let's see. So currently, this is our project is the Clasia SE Villa real estate types of real estate, and we use two different types of methods to valuation and compare them. The first one, we use the cost approach. We first collecting the ground floor area for each types of zone, including house zone, facility zone, the internal pass, and and after that we collect several comparables price of construction, so many constructor, and also the price of land, the price for land acquisition. We have table of major cost list. Here we have different types of costs, including land acquisition costs, legal fees, the ground filling for construction, house construction, facility construction, and other construction. After that, we can calculate the major cost. After a major cost, we will continue to calculate other costs, including operating costs such as marketing and sales, administrative, the auditing, evaluating, and investing agency, and also funding. That means the interest that the company has to pay within that they pay for the debt that they borrow to conduct the project. So we are having a meeting to decide the weight of every of those costs to the total, which is the revenues, because we heard from Dr. Duc said that the cost for land acquisition and all types of construction will be around 60 and also operating costs will be around like 75%. 5% will be the legal fee, and 20% will be the margin profit that the company could get. So from the total cost of construction and land acquisition we multiply it by 100 divided by 80. So we might get the value of the project, and that is at this point of time. Then we use the WACC. We adjust this because next year will be day that the company will sell their real estate. So we use WACC to predict the value of the whole project for the future, which is the next year. And that is our cost approach. And secondly, our group also have we're working on the discounted cash flow. We consider the project will be leased. We calculate the leasable area. We use comparable market approach to collect rental price within the same area. We calculate our net income from the leasable area of the project, and we use WACC to discount it back to get the value of the whole project. So that our group is currently having. This is a draft. This is a draft template of the DCF valuation method. Yeah. That's what our group are currently doing. We also writing some other part within the report, including industry research, property description, and we'll try to finish the report as soon as possible. Yes, thank you.
Very good. I just remind you all on the groups, because this is an individual, an independent project, right? So when you write in the report, people, the marker, even few years later, anyone can read your project, right? Can read your report, and they can raise any question. So it is best now in your report, you need to clarify everything, right? It is just like an independent report that a company will produce. So please take very well note that in your report, you should have something like, first, what you are required to do. First thing, we are required to do valuation of blah, blah, blah. Okay, the accurate particular property, we are required to do valuation of this, and this. Okay, for the purpose of this, and this. All right, so you need to put that very clearly so that anyone, when they read it, they will understand that, okay, this is what they are going to do. And they won't be asking later on, what are you doing? So firstly, that is to define yourself as a duty. And if you solve that duty, clearly you do it in the end of the report. Then at the end of the report, you say that in summarize, we have done this, blah, blah, blah. So that's it, end of duty. Okay, end of task. And second, in the after you define the tasks, we are going to do this, and this. And then in the methodology of the valuation, it is better to mention on the method, on the relevant method of valuation. Yeah, the valuation say the discounted cash flow, the costing plus blah, blah, blah. If you mention and you also work that out, yeah, and if you don't do any method, please write down why you don't do so. Because in the report, the more elaborated you do, the more mark you have. Even if you don't do it, just say why you don't do it, why it is irrelevant. Why is it? Because the limitation of data. If you have limitation of data, then You just mention in theory, you can do this if we have this and this. Okay, so that is the way they will show, the report will show your knowledge, your experience. Okay, and it will show your comprehensive report. It's not like you can't do it, you know how to do it. So please show everything in your report. Okay, and if you do anything, just explain why you do so. Why you do so. It is very important. And one more thing, the more elaborated, the more methodologies, the more methods you apply, you provide in your report, the more mark you will have. Because it shows you already thought of all the aspect of valuation of this particular property. Okay, so please don't ignore, don't don't skip any method in your report. Okay, don't skip any method in your report. And if you do all the research regarding to that method, and if you can apply that into this subject property, if you apply it carefully, yeah, then I believe that your report will be the most accurate for this subject property. So please do so and do it with the best duty. Okay, the best of care you can. Imagine if this is the report you send to the client. You send to the client. Yeah, and if lucky, if your report is the best, then you can, you know, you can have some awards, you know, later on by this university. You never know. So just give the best care, the best attention of each detail, of each method, of each information. You should take care of all the information. Yeah, take a good care, good research, and always raise question why you do so. Why you do this one? Is it thorough enough in your method, in your calculation? Did you miss anything? Because now it is just a student report, a course report. But if you do so, I believe that later on, remember when you apply for a job, you can even take this report to the employer, yeah, and say, this is what we did. Okay. Okay, any other group you want to share your work?
Yes, Wayne, can you share for me, Wayne? So we done on a calculation, but we haven't write the clarification why we do this and this yet. So we will do it later.
Sure.
So while waiting for Wayne to share the Excel, I will say what we will do first. We will evaluation one block of the Sunhua Group project. We will evaluate White Towers. Yes. Okay. Wings. Set for me, Wing. Yes. Can you go to the White Tower actor? The actor of the White Tower. Yes. So first, we will calculate the acre of the White Tower up the first floor and on of the White Towers. So we have the number here. We also calculate the acre of lobby and elevator. We estimate about 10% of the total floor. So next to WACC, so first, we calculate WACC based on CAPM. We use the inflation rate of 2022 because we find Sunwa beta but not the Vietnamese rent, so we use other Vietnamese real estate big company beta, and we estimate the average beta of Sunwa is 0.97, and because the Sunwa use 100% equity from the Sunwa Vietnam Group, so the cost of equity equal the cost of capital of 50%. Next we come to price of building material. Yes. This is we calculate on everything we can find about the construction cost, the furniture cost, the cost to hire the architect to make the blueprint for us, and the cost of finishing the room, the apartment. Can you run it down slowly for us? Run it down slowly. Run down slowly. This is on the slide, and we multiply it on the aggregate of the White Tower for the total construction price. So we come to the cost abroad. This is too much. The cost abroad will be easier for you guys to see. A cost abroad. Cái cost abroad ở dưới á, Nguyên. Cái trang cost abroad đó. Yes,
The next sheet. Yeah.
Yes. So we have inflation rate from 2022 to 2015, and we have the land work from 2017. So we don't calculate the inflation. That is 33 million per square meter from the price of 2017, and the total aggregate of the one floor of White Tower is up around 800 meters. So we have the land work of White Tower, and about the construction, we have the construction is about 1.7 trillion VND, but because the project is start from December 2017, so we estimate that on 2017 they just only do 10% of the work. So because it's 2017, they must buy the land for the White Tower first and do 10% of the work. So we have the estimate construction cost of the years is 10% of the 1.7 trillion plus the total land work of White Tower. And 2018 is also sorry, I forget to mention that we divide the induction reverse induction rate to the 27 bấm vô cái induction đi cái dưới cái 2018 2019 gì cũng được, cái reverse induction đó. To 2017, 2018, and 2019 respectively. So in 2018, I think that they just do 45% of the work, and I think it in 2019 they must do the furniture, the cost of cost of commission the apartment, and so on, and on to the cost of management. We estimate that I think it not change really, so we just remain it the same for on 3 years, and we uncalculated and we divide on the total aggregate of the White Tower, and plus for WSCC from 2020 2022. We have the right that is about 7 million Vietnam đồng for the square meter, and from the so we come to the comparable way. The comparable is the table for what we use to estimate the similarity, the type of room, the investor, the type, etc. And we come to the table where we when we as that mentioned why price, so we based on the other thing we minus and plus the percent. So for total we estimate Sunwa for in 2022 is 73.7 million Vietnam đồng. So on up to 3 method, they different less than 10%. So we think that we do it right. It's right, not wrong. So that's all, teacher. Thank you for your listening.
Okay, I will say before I forget, say for example, Yin, you just previously you just mentioned that Dr. Dick say this, so you apply that into your report. I reckon that you may not write like that. You better you search. Say you can ask Dr. Dick if there is any reference for that, and you better post that reference rather than you say Dr. Dick say that. Or one other way is you can say you can search on say the industry or the valuation industry, you know, and you can cite that, say on the internet that you extract on what day. Okay, so you can also do that. It's still better than you quote a person because even that person needs a reference. Yeah, like say if I say something, I have to quote that it is based on what document. Yeah, or if I say so, then I should write down, you know, like in report, something like that. It will be better than to say based on our interview. Yeah, of course, if you say you interview, say a director also or head of the department of that company, then you can write down that person interview on what day, blah blah blah. Okay. So again, regarding to the information, say if the report you will break the report into many sections, right? And each section maybe 1 or 2 person in charge. So you better each section should remain independently. Even say, for example, the first section you say blah blah blah, and then the second section maybe continue the first one, but you better mention briefly first session have done what, right? And now we continue to do what. So each section will I reckon that a little bit redundant, repeated, not redundant, a little bit repeating, but it's still better than you miss something. Yeah. And again, if you say you use what information, you better put 1 or 2 more sentences that how it is related, how it is relevant to your task. Okay, say for example, if you say you calculate the cost of the common area, then if you give some explanation to convince, because say, does it, you know, are related, is it related to the valuation, to the relevant subject property or apartment that you are evaluating or not. Okay, because anything, if you give a cost of something, you calculate something, then you have to give the relevant, anything relevant. Otherwise, if you say you calculate something that there's nothing related to, right? You need to give evidence. You need to give some convince to persuade people that of course this cost is relevant to this one. Says like that. Otherwise, say the common area. But if the common area in say in another block or so, then why you have to include in the evaluation of this one? Say for example, and what else? Of course, when you provide a thorough calculation like this, you will also support this in the index. The more supporting index, the more detail of that, the more helpful and better for the reader. The potential reader of this report will understand and are more convinced to them. Okay. What else? Because at the moment, I reckon that you give very detailed, but yeah, again, each report should be say, for example, if I read this section, then I may forget what previous section have done, right? So if you give a brief, paragraph of what previous have done and what this section will attempt to do something, right? So it will give a good idea and a good vision, good track for the next one. Okay. So that is my feedback. If you have any question or anything to ask me back, then please do so.
Can I ask about what should we include in our video presentation? Because we cannot cover everything in the report via section. Yeah, so regarding to the video report, you will ask, verify with Ms. Lin regarding to any time limitation. Yes. Okay, if there is time limit, then you have to allocate the time for the content, right? Yes. Because at the moment, I don't have the time limitation detail for that. So I assume that the video report is just like what you will present physically. Okay, so technically you will have the agenda of the content, right? Of your report. The agenda will include your tasks and what you will do, how many methods, and what we try to show, we try to prove. Okay. And then you should allocate the time for each part properly. And you will, I reckon that you will combine your presentation with the photo of your work, yeah, so that they will, they have some rule, some evidence what you have done. Even you can show some photo or some video also of your group work. Even like individual member go to the site to do the valuation or to collect information. If you include that into the report, that will be best. Okay.
it just show more, how to say, more alive to your report. It's like a video, and that will be very good record for you later on. Okay. Yeah, so you will have to calculate, allocate the time accordingly. What your group will have to decide what part is more important. Okay, against the time limitation. Okay, say for example, if there's no time limitation, then you will allocate as much as you feel which part is your what to say, your best part. Okay, if you feel this part is best, then you put it more, but it doesn't mean that you love this the best and then you put more time in that and you ignore the other part. It should not be like that. It should be balanced. Each section should be relatively equally important. Okay, it's just like your knowledge. If you think that I'm not good at this section, then I will allocate less time for it, then you may be in trouble. Okay, because each section, like in the report, each section should be equally, not a section is too long and the other section is too short. If it is too long, because it is required, so say for example, say the calculation, the explanation, why it is relevant also, then it is important, obviously. But the other sections should be also well pay attention to. Okay. And remember that this is a professional report. So try not to use the term like like Hương or someone just say that our calculation is correct. Try not to use the term like that. Use the term more professional in the way that so our calculation is supported by or our actual information that we found support our calculation, something like that. Yeah, we use the term support or match or agree. Yeah, don't use the term that our calculation is correct, because we are calculating correctly. We try our best, to our best, it is the correct calculation. Yeah, the only thing is the actual value that we found support or agree with our calculation or not. Okay, so use the term more professional that way. And always imagine that we are professional and we try to perform, we try to reach our work, our report into a professional level. Okay, so that is my feedback. If you ask more, I may have more idea. Otherwise, yeah, any other group? Any other group? So any questions so far? anything regarding to your case, regarding to anything that you want to clarify? Even if you want to chat with me or you want to ask me something, you can also message me or say on my Zalo as well. Now I changed my Zalo number into the Australia number. So you can, if you want, we can contact if needed. Yeah, so my number I will put in the chat box. Okay, so the first, because I just replaced my Australian number as for the Vietnamese number. So yeah, if you even later on, if you have any question or you want to share anything with me in your work also, I'm very happy to connect with you, okay? And if you don't have any question, then I wish you all the best in this course. I wish you all have the good mark. Your report hopefully will be one of the report that you are proud of, and you will bring this to your future employer. Okay, and wish you all the best in your future career as well. Okay. So anyone else have any question?